Hi everybody, welcome back to my channel. This is Oliver Wiedmaier, founder of Voyage Trading Group. You can find me on X at Ali_all caps. Today I want to discuss short bases versus long bases, when to trade a short base, when to trade a long base, and exactly what it is we're looking for when entering in one of these bases. So before we get started, I always like to do a quick introduction of what it is that I trade, how I trade them. Very simply put, I'm trading momentum that's coming out of a tight consolidation that usually is kicked off from a gap up or some sort of catalyst. And so the way I trade is, an ideal situation is a trade, a stock is neglected for a long time, and then there's a big gap up on, some sort of catalyst, you know, uh, usually trading 3, 4, 5 times the volume, really creating a big momentum to the upside. And then from here, it would either trade up like this, few days consecutively, or it will drift a few days and then break out. We will trade them either on the first day, or we'll trade them as what we call a delayed entry on the next breakout in that consolidation, the first consolidation after that big gap up. And so typically what it looks like is it looks something like this. You have a big momentum burst, pulls in, momentum pulls in, but eventually the stock does have to have a longer base. This momentum typically is short-lived, several weeks, not several months, and then so profits will be taken, and that's when the longer base is created. So what are we trying to do? Well, we are trying to trade from the smaller bases, okay? And that's where we're going to extract the most gains, especially when you trade higher ADRs stocks. The short bases create just a launch pad for volume pressure to rise through, and then we'll trade that momentum up. But a stock doesn't always have to have a big momentum burst and then a small base. It can have a big catalyst move, and then it can drift for a few weeks and then move up. So this not necessarily is a delayed entry because it's been several weeks. A delay entry is really just within the first 2 to 7 days of that big gap up. The continuation breakout would be several, maybe 10 to 14 days later. But during this big momentum, you have little bases that are created, and then ultimately the best scenario is it gives you an opportunity with a longer base, and then you can catch it too. So when we run our scans, we're looking for this big long momentum phase, and then we are looking with our eyes to identify tight areas in that longer base. So let's look at a couple examples, and then from there we'll head over back to this screen, and we'll go over what it is we're looking for, moving averages in a low volume drift. So we'll use ASTS as an example. It has this big gap up on the highest volume ever. It moves up, and then it drifts down to the moving average, okay? And then so here you can either take the entry on the first day or on that delay entry. But this would be considered a delay entry because you are in this kind of area where the gap up is. And so let's use this as a better example. So you have a stock that's moved up quite a bit, and now it's trading sideways, and it's slowly fading into the moving average, and then it has this big breakout. And so what we are looking for when a stock is breaking out from a consolidation from a big momentum burst is that the range is expanding. And so that's what we mean by a breakout. We want the candle to be much greater than the previous 2 days, for sure, previous 2 days, but greater than the consolidation. And so we don't need to use, a lot of people will use like the high of the previous day as a trigger. We're not doing that in this scenario. In this scenario, we're just waiting for the stock to confirm the breakout by showing range expansion. And so it's drifting into the moving average. The volume's drying up. It's getting very tight. You see the range tightening indicator, RTI, has an orange dot here, which signals that it's 2 days tight. And then it has this big range expansion. So this is a valid continuation breakout. And so this isn't necessarily a longer base. However, it's not a short base that is right after the big catalyst. So what I want to really portray in this example is that you need to wait a little bit longer. If you got caught in this false breakout, it's because you didn't give it enough time to drift into the moving average. So if this was on your watch list, this should have been on everyone's watch list because of the momentum, right? You find them in your momentum, your daily and weekend momentum scans. But it's now your job to use your eyeballs to judge the consolidation. And is it drifting? Yes. Is it showing support? Yes. But it has not drifted into the moving averages. It is fine when it's right by the big gap up to have a real quick pause and then it continues. But once the stock has already established the momentum, you no longer can trade very, very tight bases. You need them to be a little bit longer. And what I mean by a little bit longer is we want to see the stock drifting for more than 5 days, more than 7 days. You want to see it drift. So this could have tricked people because they're having FOMO, right? You only would take this entry here if you're having FOMO. You're having FOMO because you want this move to happen again, but it's just not time yet. Okay, so it doesn't go anywhere. It still moves, finding support on the moving average. Volume's drying up. Okay, it's drift, very low volume, drift into the moving average, and then you have the big range expansion. Okay, so you don't even need this line. You can just use your eyeballs that it drifted into the moving average. So let's find a example when you can use a shorter base, a very tight short base. Well, here you have the big gap up. It sells for 3 days and then it has the big range expansion up. So this is in that kind of volatile area that I call it the turbulence zone because it still has not followed through from that day one. And so any range expansion, whether it's 2 days, 3 days, 4 days after that big, if it's in that area, if it's still in the turbulence zone, it's valid. But you need to wait. So again, what happens is the stock moves, it's established momentum. Well, some people got tricked on this candle here because it is having a range expansion, but it has not drifted yet. So we need more time. The tight base is gone and went. It's here. It's not once the stock has already made the established. Once the stock has established the momentum, you need to let the stock drift into the moving average before that big range expansion. We use AGX as a great example here. It gaps up. It doesn't go anywhere. So this is the turbulence zone. Sorry. This is the, let me see if I can zoom in. This is the turbulence zone. Okay. So it needs to get out of the turbulence zone. Okay. So even this gap up, or I'm sorry, even this breakout here, this is valid because you have the 2 days tight. It moves into the moving average and then it breaks out. Okay. And then what we are looking for now is any add-ons. We need the add on to be away from the breakout, and all other rules apply. So we're looking for a drift into the moving average and a range expansion. And so where do you get it? You get the range, the selling into the drifting into right here. You get a drift. You see the volume lowering, and then you get another range expansion out of the moving averages after the 2 days tight. Here you have 2 days tight. You have the low volume, and then bam, it does another range expansion. Now, I've said this in a million other videos. The range expansion doesn't have to be this ginormous, 8, 10, 12% breakout. It just needs to be bigger than the previous candle. It needs to be bigger than the 2 days tight. So this is a very subtle breakout, but it's fantastic. It's a fantastic breakout. Now, what happens here is this has a lot of people's attention because they just made a gap up. It was on high volume. Okay, it's making new highs. And so people are looking to enter this stock, and it's going to cause a lot of fake breakouts because it has not drifted into the moving average. Once it tightens up and drifts, then you can enter the trade. Just because it gaps up and it's holding tight does not mean that every breakout from that turbulence zone is going to work. You need to make sure it actually breaks out. It actually has to have the range expansion. If it does not have the range expansion, it is not a breakout. It's a fake out. We'll use one last example in deck. Oops, sorry. Okay, so you have this big gap up. It's trading, trading, trading. Now, this has not drifted into the moving average. So this, for me, would not pass my criteria. I would not take this. Does it work? Yes, but it does not pass my criteria. What does pass my criteria? This breakout here passes my criteria because it's faded into the moving average on low volume. You see the low volume. Price gets real tight. You can see the RTI has dried up. Okay, and then it has that range expansion. You can see it's a large candle, much larger than these candles. And then it moves up and it works. So that's what I'm looking for. I'm not looking to trade this breakout because it has already passed the turbulence zone. Once it's out of the turbulence zone, I need it to drift into the moving average. I don't mind if it's going to be tight, tight, and then breaks out, and it's off the moving average, no problem there. But if it's out of the turbulence zone and then tightens up, I don't want it. It's either I'm trading in the turbulence zone and extended, good to go. Or away from the turbulence zone, needs to be coming out of a moving average, coming out of that with that range expansion. So that is what I do. That is how I determine whether I'm going to trade a short base like Reddit, right? Has that short base because it sells off in that turbulence zone. So I'm okay with that being extended, no problem. But when it's extended outside of the turbulence zone, I am not interested in trading that. It needs to drift on low volume into the moving average. So I hope that helps. If you have any questions, let me know. Thank you for watching.